Hello and welcome to the program. I am Bisi Adebayo. Coming up today, South Africa's unemployment rate rises to 30.8% in the third quarter. IMF projects 3.6% contraction in South Sudan's economy in 2020 to 2021. Plus, Egypt's debt declines to 78% in June 2020. But let's get the show started right away with intraday numbers coming from the markets we track in Africa. And the Nigerian oil share index is still very much on steroids, recording a massive jump of close to 4% at intraday. In South Africa, the GSE index was 0.03% positive, and the EGX13 Egypt was 0.25% in the green, also at intraday. And then the Kenyan Burst closed 2.26% positive on Wednesday. And in the Middle East, the markets were mixed, with the Abu Dhabi index up 0.49% and the Dubai index down 0.88% at intraday. In Qatar, the index was close to 1% positive, and in Saudi Arabia, the index was 0.27% south. Crossover now to Europe, where stocks pulled back today, bucking a positive trend seen in Asia and the US after tech stocks rallied in the previous session. Chelsea Delany tells us more about what's driving the markets today. Good afternoon, Chelsea. The markets continue to swing as investors reassess the potential impact of a coronavirus vaccine. And then tech stocks that have been benefiting from lockdown measures and people staying home have had a roller coaster week. Walk us through some of the reactions this afternoon.
It's certainly been an interesting week for tech stocks, especially for these so-called stay-at-home stocks, the ones that have really been benefiting in particular from these lockdown measures. I think a perfect example of this is Zoom, the video conferencing software that we've all really come to know and love over the past couple of months. It's really become ubiquitous with the coronavirus crisis, and it has had really a tremendous week of volatility after rising about 500% this year because suddenly there was so much demand for this software. After the news of the vaccine results was released, we saw the stock really tumble about 25% over the course of 2 days, and that's as people had this knee-jerk reaction that, okay, if we get a vaccine, suddenly people will be back in offices, they won't be needing the software as much, and these Pfizer BioNTech results were really seen as clouding the outlook for a stock like that. But we've seen over the past 24 hours or even a little bit longer, more caution set in about this narrative that we're really heading back to normal. And we've seen this once again boosting these stocks of companies like Zoom and also Peloton, the exercise bike company that has also been very popular this year because gyms have been closed, things like that. So we have seen these stocks bounce back. And also a lot of investors, a lot of analysts are looking more at the long-term outlook here and saying, okay, even after we get a vaccine, even after we reach this point of herd immunity that everyone is talking about so much, which could take months, it's likely that some of these changes we've seen through this pandemic will be permanent. People likely will continue to work from home more. We won't see as many in-person meetings or as much business travel. Some people will likely remain quite skeptical of things like going to gyms. So investors still remain quite positive on these stay-at-home stocks, and we've seen them really recover over the past couple of days.
Now, regulators are sounding the alarm about the risk of a surge in bad loans for European banks as government support measures run out. What are the potential risks?
The European Central Bank has already pegged the risks of bad loans for European banks at about 1.4 trillion euros, so really a tremendous amount of money. We haven't seen banks in Europe really struggling with a lot of people, a lot of businesses defaulting yet, and that's in part because of these government measures that have been put in place really across the Eurozone. Many countries have, for example, suspended bankruptcy filing procedures. Here in Germany, those are extended until the end of the year, so if a company is facing bankruptcy, they don't have to file immediately. So that has really kept off a lot of a lot of these defaults on loans and things like that. Also, governments are providing a tremendous amount of financial support, loans, liquidity, things like that to businesses, as well as these short-time work programs that have kept a lot of people from losing their jobs. So what this shows is that we don't know yet how big of an impact these bad loans are going to have on the economy. It's really a black hole right now, and many people are warning that banks are being too optimistic about the potential losses here, because it hasn't really materialized yet because of all these government support measures. But over the next couple of months, some of these will start to expire, and we could be looking at very significant amounts of defaults, of loans going bad. And these banks haven't really set up the necessary infrastructure, the necessary funds to really cover those bad loans.
Finally, Chelsea, France's finance minister today discussed his outlook for the economy as the country remains in a strict lockdown. What did he say?
So the French financial minister, he gave quite an optimistic outlook for the French economy. He is hoping that France will be open again by Christmas. That was really the main point that he was making today, was that if people in France, if they follow these lockdown rules, that they should be able to get this outbreak under control in time for people to really start to revive some sort of normal activity again by Christmas time. So this is obviously very crucial for France and for the French economy, that these businesses are able to have some sort of normal shopping period around Christmas, some normal activity heading into this crucial holiday period. France, of course, is seeing a very strict lockdown. It's much stricter than the measures in place, for example, here in Germany. If you go outside, you have to have a note. Many people really are not leaving their houses at all. And that is expected to have quite a significant impact on the economy. And in response to that, the finance minister today also said that they're looking at ways to provide more support to businesses. We heard similar comments from the finance minister here in Germany as well, about having more support available for businesses as these lockdown measures begin to bite. So certainly we're starting to see some activity among these governments to step in and help businesses again.
All right, thank you, Chelsea. You do enjoy the rest of your day. Time now. Well, it's time now to bring Juliana Olayinka to tell us how the markets are reacting to the latest GDP numbers. Good afternoon, Juliana. It's good to see you again. Tell us, how are the markets reacting to the latest GDP data?
Not great at intraday for the FTSE All-Share. It's in negative territory, and this is after this morning's record-breaking UK GDP figures. Between the 3 months of July and September, the UK economy grew by 15.5%, and this is the biggest quarterly growth that we've seen on record ever. But if you look a little bit closer behind the headlines, you can see that the detail tells a very different story. Growth is slowing, so even though we're technically out of recession, we're expected to double dip. So in the fourth quarter, we're expected to go back into recession, and that's really because growth is slowing. In July, I believe the economy grew by 6.6%. We had just a 2.2% growth in August. And we've got to think, if you think of August in Britain, this is when the sun is shining, lots of people on furlough, so spending a lot of time on the beach. We also had Eat Out to Help Out, but that wasn't enough to bring those numbers up. And then in September, it's fallen pretty dramatically to 1.1%. Last week, Chancellor Rishi Sunak did decide to extend the government's furlough scheme. So even though at the moment, historically, that 4.8% we're seeing of unemployment is quite low, it's really been saved by this furlough scheme, which will be extended into March next year. So on a whole, although it's great, not much to rumble about, because we know we are in a lockdown at the moment, and we're not likely to see the bustling golden quarter results that we would expect to see. So at intraday, the all-share is down 0.26%. The FTSE 100 is down by 0.40%. And the FTSE 250, the domestic market, slightly up by 0.28%. In the currencies market, the pound is down on the US dollar by 0.20%, down on the euro by 0.52%, and down on the Japanese yen by 0.30%. Bissy.
Retailers and supermarkets have been accused of taking advantage of lockdown loopholes for Christmas trading while other stores remain closed. Will you certify this?
It's an interesting story, and certainly, I suppose most of our viewers who are in the UK have seen that some stores may be jumping into these loopholes. We know just a couple of weeks ago now, Prime Minister Boris Johnson did plunge England back into a second lockdown from the 2nd of November, from the 5th of November until the 2nd of December. So all non-essential stores had to close, as well as the hospitality sector. But just because of the way consumers shop right now, a lot of the big stores, particularly the big four shopping centres, well, the shopping stores, so Tesco, Sainsbury's, Asda, Morrison's, many of these bigger, larger stores do sell non-essential items like homeware, they sell toys, and the independent stores are becoming increasingly frustrated, particularly at this time of the year where you would expect to see high street numbers really bustling with individuals buying as much as they can for Christmas. And of course, if you're an independent store and you don't sell food or you don't sell medicine, you're closed. But if you are able to sell these items, the independent store owners are complaining that they're seeing in some particular places toys stacked really high, clothes full to the brim, and they're wondering why the government are allowing this, particularly as, of course, it's the independent stores that are suffering the most. But it is a loophole that many are being able to go through, and it does appear that some consumers are jumping straight into it.
All right, Juliana, just before you go, tell us what's the latest regarding Brexit?
Goodness me, that's a difficult question to answer. What I do know is that there are just 50 days left, or less than 50 days, to the end of the Brexit transition period, which will come to an end on December the 31st. So even though we have left the EU, we would have officially left the customs union by the end of this year. And of course, both negotiators in the EU, in Brussels and in Downing Street, have been going back and forth, trying to find a free trade deal. Deadline upon deadline has been missed. October the 15th was the self-imposed deadline that Prime Minister Boris Johnson put in place. That was passed. We were then told to expect a deal would be done by the first weekend of November. Of course, that has passed. And Michel Barnier, the EU's chief negotiator, has been in London pretty often. I believe he's just wrapped up maybe the 15th round of negotiations with Lord Frost, his UK counterpart. And there does appear to be one main bone of contention, that's fisheries. The EU still want to maintain the exact same access to Britain's fishing waters as they had done before Britain decided to go into this messy divorce. And the British side are really not happy with that. Michael Gove, he's a senior cabinet minister in charge of a no-deal Brexit. He has said on camera today that he thinks the EU need to back down on some of their ambitious plans. But it's tough, and nobody really knows what is going to happen. The Prime Minister over the weekend did say a deal was there to be done, but we've been hearing this for the past 3.5 years. So a deal is unlikely. And of course, Joe Biden, President-elect, did call Boris Johnson a couple of days ago. And this was the first call he made to an international leader. So as though some would say that a Biden administration would make Boris Johnson much tougher in trying to get a deal, the fact that he's called him first does mean that that special relationship may be intact, which means the government may not have an incentive to push for a deal. But who knows? Next week, it may be another story, Bissy.
Absolutely. We keep our fingers crossed then. Thank you, Juliana. We'll see you again tomorrow. And stocks in Asia Pacific struggled for direction on Thursday as tech shares in the region bounced from recent declines. In Japan, the Nikkei 225 closed 0.68% higher at 25,520.88, while the Topix index ended its trading day 0.16% down. In South Korea, the Kospi was down 0.41%. We'll be talking commodities when we return in just a moment. Please stay with us. Welcome back. There's been a clamour for the reopening of the Nigerian borders, which were shut by the federal government about a year ago. The recent waiver for some companies, that's BOA and Dangote, to transport goods across the borders has only made such demands much louder. But what would be the impact of this on the domestic commodities market? Well, that would be our focus today on the Commodities Update segment. And the research analyst at the financial derivatives company, Tobiloba Ogupolu, joins us now to discuss this. Good afternoon, Tobiloba. Thank you for joining us on the program. Well, let me start by asking, what will be the impacts of the full reopening of the borders on domestic commodity prices in general?
Yeah, thank you for having me. So before we go ahead to talk about the impact of the reopening of the border on commodity prices, let me first say that yes, there's a waiver for like three companies, that's Dangote, BUA, and a gas firm, to export their products that to neighboring countries through the land borders. And what this means is like a signal to the government, is a signal rather from the government of their softening stance on land border closure. So let us recall that this time last year, the border was closed so that it will clamp down on smuggling and also to improve domestic production. And the immediate impact of that was an increase in price of several commodities. So the reopening of the border, be it partial or full reopening, would mean a reduction in the price of several commodities, especially commodities that are imported from neighboring countries. And it will also mean that the supply would increase, that supply from other countries would increase, and thereby a price in Nigeria would for commodities would fall.
Well, now that you have spoken in general terms now, the festive season is just around the corner. So let's be more specific about the festive sensitive commodities. How will the full reopening of the border impact the price of such commodities? And let's not forget that inflation is projected to increase to 14.5%.
Yeah, so for the festive sensitive commodities, we have like turkey, we have chicken, vegetable oil, rice definitely, and tomatoes. And we've seen that all these commodities, their prices have increased. So for instance, the price of rice is currently 31,000. The price of turkey from about 14,000 last year. This time last year, we're buying rice for about 14,000. And the price of turkey is about 2,000 naira. For chicken, we can buy it for about 1.5. Vegetable oil for a 5-liter keg, we can buy for 4,000. Tomatoes also we can buy for like 35,000 for the 50 kg. And all those commodities compared to last year, we've seen that they've all seen an increase in price. Then we've also seen that this is not just due to the border closure. There's been impact of flooding in several states, then COVID-induced disruptions, and also the herdsmen and farmers clash. So, but as the border reopens, like I said, partial or fully, we expect this to have impact on most of these commodities. For instance, rice, we've seen that rice is about 31,000 naira. So if the border opens, we'll get rice from neighboring countries, and we'll see that the price will gradually reduce.
Which is what everyone is looking forward to. Finally, Tobiloba, Nigeria ratified the AfCFTA agreement yesterday ahead of the December 5 deadline. What do you think will be the immediate, midterm and long-term implications on the Nigerian economy?
Yes, Nigeria ratified the AfTA agreement, and that is like few weeks to the deadline of December 5. And the agreement comes to full effect December 1, 2021, January 1, 2021 rather. And what this means is that there would be free movement of goods in and out of the countries under this agreement. And we would also see that countries would have availability to about 3 trillion market and $3 trillion market, and also trades among 1.2 billion people. So a lot of countries would want to take advantage of the fact that Nigeria has a huge consumer group. We have a growing market, and the question needs to be, what would Nigeria gain? Are we competitive enough? I don't think so. Are we would we be able to like meet export demand? I really don't think so too. So we need to like look inwards and try to see how we can improve ourselves before this agreement comes in, before the date of the agreement, which is January 1, 2021. We need to like improve investment centric policies. We need to put in all those kind of policies, and also improve, like say, transportation. We need to look at broadband improvement. We need to like look at power sector improvement. We need to look at all these things before we start to say that, okay, let us see how we would gain from this agreement. We need to put a lot of things in place.
Research analyst at the FDC, Tobiloba Okukwolu, thank you for speaking with us. In other news now, the International Monetary Fund is projecting a 3.6% slump in South Sudan's economy in 2020 to 2021, about 10% below the pre-pandemic baseline. The IMF explains in a statement released today that the health and economic impact of the COVID-19 pandemic, coupled with the decline in oil prices, led to a collapse of revenues and have created urgent balance of payments and fiscal financing needs. Meantime, the executive board of the IMF has approved a disbursement of about $52.3 million to South Sudan under the Rapid Credit Facility. Well, this is the first fund-supported financial assistance provided to South Sudan since it joined the fund in 2012. The disbursements will help finance the country's urgent balance of payments needs, contain the fiscal impact of the shock, and also provide critical fiscal space to maintain poverty-reducing and growth-enhancing spending. Meanwhile, inflation in Sudan has risen to 229.85% in October, representing an increase of 17.56% compared to September. The monthly Central Bureau of Statistics report shows the core inflation was 280.5% in October, compared to 264.59% in September. The inflation rate for the food and beverages group was 194.5% in October. And Egypt's debt declined to 78% in June 2020 and 90.2% in June 2019, compared to 108% in the fiscal year 2016-2017. And that's coming from the country's finance minister, Mohamed Maid, who says the economy's performance has exceeded all expectations, according to the testimony of credit rating institutions, including the IMF, the World Bank, Goldman Sachs, Standard & Poor's, Moody's, and Fitch. The minister notes that Egypt is leading the Middle East and North Africa region towards green investment. And finally, South Africa's unemployment rate increased by 7.5% to 30.8% in the third quarter of 2020. Data from the National Statistics Agency says the number of employed people increased by 543,000 to 14.7 million in the third quarter, compared with the second. Unemployment increased by 2.2 million to 6.5 million, resulting in the size of the labor force going up by 15.1%. And that's where we end today's program. Thank you for watching. I'm Bisi Adebayo.